Today, folks, we're going to take a look at the only two Canadian dividend stocks that will offer you a discount if you reinvest the dividends. One of these companies will discount the share up to 5%. If you don't know what I'm talking about, these are called dividend reinvestment plans, DRIP enrollment, something you can do on the back end of your trading platform, which typically waives any commissions you're going to pay, any fees to just buy new shares. And companies, in very rare cases, will offer you a dividend discount because they're issuing you a new share, and it helps them raise capital to fund their ambitions and their growth and everything else. And typically this isn't something I would recommend because a lot of people talk about this as a dividend snowball to build over time, but typically companies that pay large yields or dividends at all are more mature companies, and they don't typically have as much growth ahead of them. But that's not the case with the companies we're about to talk about. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey, hit that subscribe button, because the two companies we're going to talk about is MCAN Mortgage Group, which currently yields 7.6% in its current dividend, trades at a very reasonable valuation, and is currently offering up to 2% on dividends reinvested. And then we're going to talk about Emera. This is a massive utility company, mainly focused in Florida, but does have some Canadian operations. I'm going to say it trades for reasonable value, but it's almost a $19 billion company with a 4.4% yield, but currently offers an insane 5% discount from the average market price for shares repurchased in connection with the reinvestment of cash dividends. My God, guys, there are few and far between companies doing this today. And the Motley Fool, you suck. I recently was doing some DD trying to find other companies doing this, and they posted this article back in February 2nd of this year saying top Canadian drip stocks, and the Canadian banks used to be quite resilient for doing this, and they mentioned that Bank of Nova Scotia, Bank of Montreal offer these dividend discounts, but they're literally saying you can get a 2% discount on common stock when purchased under a drip program. That is a lie. I think they just made a really old article, updated it slightly so they could keep reposting it every year. But the reality is Bank of Nova Scotia, BMO, you just do a quick Gemini search or even go into the bank's investor relation page and you'll see they canceled these programs, you clowns. I'm the king of the Finfluencer clowns, guys. I'm trying to give you the best direction possible here, not as financial advice, but the fact that such an OG company like Motley Fool doesn't even do any DD anymore just blows my mind. It just shows you how insane it is that you really need to do your own due diligence. But on that note, let's dive into this, guys, with MCAN Mortgage Group. This is actually one of the largest lending companies, private lending companies, independent in Canada. I mean, it trades for almost $1 billion in its market cap and actually trades for quite a reasonable value. I will say, because it is a smaller cap company, it does go through periods of extreme volatility, but has a nice track record going all the way back to basically the mid 90s. So it's a company you want to buy when it goes through severe dips. It's not uncommon for this company to drop 25 to 40%. As smaller cap companies do, and you want to kind of lock in when you get closer to that 10% yield. That's where the real sweet spot is, in my opinion. And they have a dividend growth rate actually of almost 6%, which is quite impressive over the last 5 years, considering we look at the dividend. To have this long of a dividend growth rate for a mortgage company it's incredible. It's really actually quite incredible. So we know we're getting a 2% discount again on those dividends reinvested, but let's talk about what the company is doing more specifically, right? So if we just go to their website here and we take a look, reimagining opportunity to drive growth for Canadian communities, and they have 3 verticals as far as I can tell. Mortgage lending, if you need a private mortgage, you can go to this company. They have flexible financing solutions for those that want to invest their capital. You can invest through them, at which they'll loan your money out to these people, whether it's in construction loans, private mortgages, whatever. And then they have MCAN Wealth, which is also really intriguing because they offer their own GICs, which is great. And these are pretty reasonable rates for where the interest rate currently sits. So, I mean, you can lock in a 5-year at almost 4% right now, which I think is still quite reasonable for Canada, considering our interest rate is now at what, 2 point something percent. We're in like the mid-low 2% range. I'd have to double check. But regardless, look at the growth behind this company. I mean, we're talking about a company that was doing revenue of $96 million in 2021, and in 2024 did an annual revenue of $127 million, with projections still to grow. From the balance sheet perspective, they're like the banks. They do have a lot of liabilities because they're loaning out capital, right? So that has to be marked down as a liability, but it is also an asset to them. So you kind of get liabilities and assets that do overlap on a balance sheet like this. But we can see they've got about 22% in uninsured mortgages, residential, and then they have 47% insured residential mortgages and about 21% in construction loans, and then a mix of some other investments and equities. Very, very simple to understand how this company operates, which is nice. From the balance sheet perspective, and what I wanted to look at when we talk about the banks is the provisions for credit losses. What we want to understand is the default rate, because this will tell us, how scary the economy is from this independent lending company. And to be fair, things have improved, and this is why I'm so bullish on the Canadian banks and the economy. I mean, for this company, if you go back to basically 2024, mid 2024, and you look at the quarter over quarter, their default rates were hitting as high as about 3.5% for impaired mortgage ratios, even from the impaired. And this is like basically, non-securitized. And again, kind of crazy that they were getting up to 3.5. And I told you when I reviewed this company in the past, if that continued, you'd want to be very concerned. But now we're seeing a leveling off, not only in this private company, but in the banks as well. And they're back down to 2.34%. That is a material drop. And it's very awesome. I think this is a great company overall. I'm thoroughly impressed by it, and I'm surprised it hasn't made its way into my portfolio, to be honest. I think it's something my parents hold in their retirement. I wouldn't make it a huge position, but man, for the growth you're getting, the dividend discounts, could you really go wrong? I think it's quite an impressive company. So let's talk about Emera, because for stability, I don't think you can go wrong with a company like this, but similar to that, similar to MCAN, you really want to buy this when it dips materially. Current dividend yield is only 4.4%, $20 billion company, year to date up 22%, just crushing it. But anytime we get these nice little dips, which maybe 5 to 10%, it's where I would start maybe accumulating some shares, because this sucker offers the real discount on those dividends. It'd be nice if you could lock in a 10% yield, because we could get a 10% yield at a 5% discount on those dividends reinvested. Whew, if you want to talk about dividend snowball, baby. But we're not going to get that here because it's a more mature company. The yield's a bit lower. But regardless, the 5-year growth rate's been pretty nice. On the dividend scorecard, we can see it's about 3.43% for a mature company like this in the utility space. You can't really complain. Actually, this is the 18-year, 5-year, but the dividend growth has been over 18 years. So, very reasonable for a mature company. We're getting some good growth. 5-year, it's only up 20%. Not the best growth over the 5-year, but year to date really coming back. These are the kind of companies I look at if I was kind of building out my retirement portfolio, but I'm just specifying them today because I think there's a real case to be made of making real returns just off dividend reinvestments if you buy enough shares. So let's get a better understanding of this company, because again, they're primarily focused out of Florida, Tampa, and I want to break this down a little bit more in depthly, but 70% of their adjusted net income is from Florida utilities. And if we take a look at that a little more in depthly here, guys, they got $43 billion in assets, 2.6 million customers, 6 high quality regulated utilities, $20 billion of a 5-year capital plan. There's a lot going on. And what's more intriguing is the client side of this, which we'll look at. But to give you a further breakdown, you can see Atlantic Canada makes up 27%, and then other is about 8%. So it's nice to see there's a bit of diversity, but they're highly reliant on Florida. But what's really intriguing is you can see 21 military installations, 16 seaports, and 2 spaceports. This company is not going anywhere, and they definitely have a monopoly as the largest utility provider basically of Florida, which is quite impressive. And if we take a look at the revenue growth, guys, it's pretty impressive. 5.7 billion back in 2021, 7.2 billion as of 2024, expected 8.2 billion here this year. Not bad at all. My only concern with these companies, again, is the dividends reinvested are likely new issued shares. So if we take a look at the ordinary shares here, we can see there is dilution going on, because this is what utilities typically do. They reinvest the dividends to offer further value and growth. If we take a look at MCAN one more time here, and we just take a look at shares issued, it does go up quite materially from 29. I think this is in the billions, maybe. Maybe thousands, million shares, might be million shares, but goes up to 35 million. Just within a couple years. So they are diluting a lot, but the reinvested capital is offering decent shareholder return. So I don't mind it all that much, but I wish there were more Canadian companies that did this, because it makes a real case for the dividend snowball, as dividend investors like to call it, because I think it accelerates the rate of not only your dividend growth, but your return, because all those shares you're now buying in the future come at some cases a pretty severe discount of 5%, which, by the way, if you get shares at a 5% discount, those shares this, if the yield is 4.7%, that 4.7% is getting a 5% boost on top of it. It is quite an astonishing thing to actually consider, and something that maybe I'll implement into my portfolio just as something to follow and pay attention to, because it is such an intriguing it's just such an intriguing investment thesis, and just to see what the real returns look like maybe over a year or two doing so. Let me know if that's something you'd like to see on this channel, but otherwise I'll pass the question off to you. Let me know if you found any other companies that do this and what you think about it in that comment section below.